Hello everybody, so this is the second video for Chapter 7 of the Introduction to Quantitative Finance course. So in the previous video, we've discussed market anomalies, which are facts or evidence collected from market data, which is inconsistent with what we define as the efficient market hypothesis. Okay, so these are facts or observations which can difficultly or hardly be reconciled with the efficient market hypothesis or investor rationality. So as we mentioned, when we observe these outcomes, then we ask ourselves, why do such outcomes occur? What's the reason why we observe these types of market anomalies? Because you would think that investors could exploit them if they were rational and then make some profit and beat the market. So how come such anomalies are not exploited and still observable on markets? Well, one possible answer relies on psychology more than quantitative finance per se. Okay, so or let's say rational. Okay, not quantitative finance, but I'd say it relies more on psychology rather than simply analyzing rational behavior. So behavioral finance is a discipline that was developed in recent decades, which tries to explain choices made by investors or individuals based on psychology rather than pure rationality. Okay, so investors are human beings and they are subject to biases. Okay, so humans are not fully rational. Sometimes they use shortcuts to make decisions, and these shortcuts lead to some biases. So why is that interesting? It's because such biases can provide sometimes useful explanation for some of the market anomalies that were discovered in the literature. Okay, so these biases can sometimes explain why securities might deviate from their fundamental value. So the pioneers of behavioral finance are Daniel Kahneman and Amos Tversky. I hope I pronounced the names correctly. And they were awarded the Nobel Prize of Economy in 2002 for their work on behavioral finance. Okay, so this discipline has become extremely well known, an extremely active area of research and a very important discipline. Okay, so there are still nowadays a lot of people working on this field. So what we're gonna do next is to discuss various biases that are encountered in practice in decision making of investors. Okay, so such biases, they have very important financial implications since they impact the way either investors or traders make their financial decisions. And because it impacts their decisions, this can impair the price of securities, in the sense that if the decision making of investors is sound, is not sound, some securities might be either overvalued or undervalued, and we could observe some mispricing in the market. So we will discuss a few common biases seen in the behavioral finance literature, but it's in no mean an exhaustive list. Okay, there might be other types of bias that you can encounter in practice, but we'll just discuss a few to give examples. So a first very common type of bias is overconfidence. Okay, so people sometimes tend to exhibit very high confidence in their own judgment, even sometimes too much. Okay, So, for example, people might tend to disregard events that they think might never occur, even though there's a slight possibility that they would occur. Okay, and of course, these events would be unfavorable to them. So, how can we apply this to finance? Well, traders sometimes or investors they make trades, uh, and these trades sometimes have some risks associated to them. Okay, so if you purchase an asset, maybe in some scenarios, the value of that asset might plummet due to a very rare but true risk, for example. So traders might tend to disregard these very adverse scenarios, thinking these scenarios will never occur. I just won't factor them in my pricing decisions. Okay, so of course, if you disregard the risk associated with an asset, you will have a tendency to overprice it. So people might overprice certain deals just because they disregard some risk associated with some trades because they're overconfident. Another type of overconfidence is for active fund managers. Some of them might be over optimistic about their ability to beat the market. Okay, so they might not have any genuine skills in beating the market, but they might think of themselves as having these skills. So if they believe they are over optimistic about their own abilities, it might lead them to do some excessive trading. Okay, so they might think, okay, this is going to increase, this is going to decrease, so they trade, and excessive trading leads to heavy transaction costs, which ultimately decreases their performance. Okay, so uh, overconfidence can have very adverse impacts on the performance of traders or portfolio managers. So it's very important that uh, people who do investment decisions are well aware of risk and make sure they're not blindly overconfident in their own abilities. Okay, so always exert some degree of self-doubt in practice. Another very famous type of bias is availability bias. So when assessing the probability or the likelihood of various events, people tend to search their memory to assign such probabilities, and they often implicitly assume that the future is likely to resemble past or recent past events they experienced. Okay, so how does this risk impact finance, or this bias impacts finance? Well, if you're a risk manager and if you're susceptible to this bias, you might protect your company a lot from risks which occurred in the most recent financial crisis, and not protect your portfolio or your company enough against risks that might happen but never occurred in the past. Okay, so people who are susceptible to this bias, they are susceptible to thinking that all the next crises in the financial markets, they might look similar to the previous ones. But in practice, if we check the various crises and the two recent decades, for example, all the crises were dissimilar in some regards. So they all were triggered by different factors, and thus simply protecting your portfolio against adverse outcomes which occurred in the previous crisis does not mean you're well protected against the next crisis. Okay, so you have also to consider emerging risks that were not happening, like, or didn't impact your company in the past, but that might impact your portfolio in the future. So simply looking at your own memory to assess the likelihood of events or what events might occur or not is not sufficient. You have to go beyond that. Okay, think outside the box sometimes. This last bias, availability bias, is also related to another type of bias, which is representativeness bias. Okay, so this bias is associated to the fact that sometimes people extrapolate a rule for all possible cases simply by observing a few of them. So, an example pertaining to investment, let's say that some analysts, they've seen 3 or 4 stocks which all share some characteristics, and these 3-4 stocks they have beaten the market in the last few years. So this might lead the analyst to conclude that, well, all shares having such characteristics will be the market in the future and invest in these shares. But it's not necessarily the case. Okay, there might have been something particular with these 3-4 stocks other than the characteristics identified which led them to outperform the market. It could even be only randomness. Okay, so they were lucky and they beat the market in the last few years. But extrapolating general rules out of a few idiosyncratic examples is not necessarily a good idea, and it's a biased decision to make. Another type of bias is heuristics or thumb rules. Okay, so heuristic and thumb rules, they're mental shortcuts that people do to make some decisions. Okay, so sometimes making informed decisions requires a lot of effort, of thought and time. So to avoid the burden of heavy decision-making processes, some people use mental shortcuts or thumb rules to make these decisions. But of course, when you make a shortcut, sometimes it ends up not being a good shortcut. Okay, so for example, let's discuss technical analysis. So technical analysis is a discipline where people look at charts of stock prices, so their historical stock prices in the last few, let's say, a year or a month or something like that, and based on the patterns they observe in the chart, they try to extrapolate their behavior in the future day, future week, or something like that. Okay, so for example, if they see some pattern, so if the stock price goes like this, then in the future it should go up or something like that. So they have some book of rules which try to predict future stock behavior based on patterns in the charts. So the profitability of these type of trades is very controversial and debated in the literature. Okay, so I don't want to say it works or it doesn't. I'm not an expert in that field, but it's not clear that these types of trades do work. Okay, but again, I'm not advocating any side on this. I'll let the expert discuss that. But we can see that it's very easy to make a thumb rule by, let's say, if you observe some type of patterns 3-4 times for various stocks, it's easy to extrapolate that, okay, these patterns should happen all the time, whereas it's only a shortcut you've made and there's no fundamental reason why this pattern that occurred in the past might repeat itself in the future. Okay, so we can see that for this example, it's also related to availability bias because people see patterns based on, like, they have a recollection of patterns they've seen in the past, and they extrapolate that these patterns should always hold, whereas in practice it's not always the case. Okay, another type of bias is misconception of randomness. So a lot of people tend to assign a meaning to events that were only due to randomness. Okay, so for example, two events might occur simultaneously without being related together. Okay, so this could be an example of correlation without causality. Okay, so sometimes two events occur together, just they happen together, but they're not tied together. So in finance, one example that is a bit funny is the Super Bowl effect. Okay, so for a while, it was observed that there was a very high correlation between the stock market in a given year and the conference. So conference is like the division of the Super Bowl winning team of that year. Okay, so the rule was that if the team, the Super Bowl winner was from the American conference, then it should be a bear market the next year. If it's the national conference, then it should be a bull market. Okay, so of course these events are completely unrelated. They have nothing to do like there's no rational reason why both should be related together. Okay, but just out of luck, they were related together for several years. So some people have extrapolated this as a rule. Okay, but clearly it's a spurious correlation. And if in recent years people have tracked down this index or this predictor, and in recent years, of course, it did quite badly because it's not a genuine predictor for stock markets. It's just something that happened out of luck. Okay, so this illustrates that really it was a spurious correlation that happened just out of luck, but it has no value whatsoever for investment purposes. Another type of bias is belief persistence. Okay, so this is the stubbornness bias. Okay, once people form an initial opinion about something, they tend to firmly stick to that opinion, even sometimes in the presence of information contradicting their belief. So, in psychology, this is known as cognitive. I think in English it's cognitive dissonance. In French, it's dissonance cognitive. It's people who, once they form an opinion on this, they'll stick to that opinion regardless of what facts are presented to them. Okay, so examples of application to finance. So if a trader has done profitable trades using a strategy in the past, and at some point the strategy stops becoming profitable. Okay, so behavior in financial markets, they change through times, things evolve. Sometimes strategies that were profitable in the past, they become unprofitable. So for example, if there were arbitrage opportunities in the past, maybe some people have noticed it, and then if you try to apply the same arbitrage now, it just won't work. So an example of belief persistence is a trader who's profited from some strategy in the past, and that strategy at some point stops become profitable, and the trader starts losing money, but then the trader still sticks with that strategy because he formed an opinion that that strategy is profitable. I don't care if in recent years I've lose money on it, I'm gonna stick with it because I know it's profitable. Okay, so this is a type of belief persistence that can be found in finance. Another type of belief persistence is investors might be reluctant to dispose of bad investments on which they lost money. Okay, so for example, uh, if people they think a stock is good, they buy it, and then the stock plunges. Well, some investor might still continue firmly believing no, this stock should be a winner. It should go up at some point in time. Okay, so they stick to their belief that this stock should go up. So even though the stock loses money and becomes unprofitable and the financial situation changes, becomes more adverse to the company, they'll stick to their opinion and keep up investing in the same stock that has become bad. So uh, you can think of this last example as the casino. Okay, some people go to the casino and they continue playing, thinking that someday they will win money in the casino, and they'll earn a total amount which is more than their total loss in the past. But in practice, this typically never happens. Okay, if you go to the casino, the most likely scenario is that you'll lose money. Okay, so if you make a bad decision, or if you make a decision and circumstances change, you should be willing to change your opinion, your belief, to adjust to new realities and make decisions that are optimal as of today, not optimal as of a few years ago. Okay, another type of bias is anchoring. So this is a bit related to the belief persistence one we've discussed in the previous slide. Anchoring says that often people form an estimate of something, and as information comes by, then instead of uh, fully redoing the analysis, with the new information, they will just take their estimate and adjust it slightly in the direction of new information. Okay, so this is some form of belief persistence. They just take their belief and slightly adjust it instead of redoing the analysis from scratch and um, getting the new outcome. And this anchoring, uh, it can very well explain underreaction. Okay, so people might underreact to news because they formed an estimate. Okay, the stock price for this company should be worth $50, and then if there's good earning in the financial statements, okay, I'll adjust it to $51 instead of fully redoing all their forecasts, and redo the full analysis. So it might explain underreaction, and for instance, the post-earnings announcement drift, market anomaly that was discussed earlier, can also be explained by this anchoring bias. Okay, so when there's a good earning, instead of adjusting right away the stock price and then the stock price behaving like a random walk, investors will be too slow to react. They'll only adjust their prices incrementally, slightly at the time. So this is why there's a drift in the price instead of having a sudden adjustment of the stock price shares when the good news becomes public. Okay, another type of bias is familiarity bias. So we tend to exhibit excessive preference for the situation with which we are familiar. Okay, so when we know something, we tend to prefer it to something that we don't know. And this, we say it's a bias, but sometimes it's rational thinking. Okay, so when you do something that you're not familiar with, there's a lot of things that might happen that you don't even think of. So there's always what's been called the unknown risk. Okay, so sometimes when you do something, there are known unknowns. So, okay, so you know that this, I don't know that, but I'm aware of not knowing that thing. But sometimes when you do something new, there's things you don't know, and you don't even know you don't know them. Okay, so this is a very undesirable outcome because you cannot protect yourself against this uncertainty because you're not even aware it exists. Okay, so there might be rational reasons why you might be preferring more familiar things. But sometimes this line of thought leads to excessive preference for what's familiar to you, and then it becomes a bias. So in finance, an example of how this materializes itself is under the diversification. Okay, investors, they tend to invest too much locally in their own market. So for example, if you're a Canadian citizen, then you might invest like the whole lot of money in Canadian stocks. And doing this, you will miss the diversification opportunity provided by other markets. Okay, so we've seen in chapter 4, for example, that if you want to have a high expected return while minimizing risk, you have to take advantage of diversification. And investing in various geographical markets, it provides some diversification benefit. Although in recent years, geographical diversification might have been smaller than historically because as time goes by, the markets are increasingly connected together and they tend to be more correlated than before. But still, geographical diversification can still provide some degree of benefit today. And people who are susceptible to the familiarity bias, they might do insufficient geographical diversification of their portfolio. Another type of bias is herding. Okay, so this is the tendency to follow the same behavior than their peers. And the justification for that is to avoid the social stigma of being alone suffering a bad outcome. Okay, so how this applies to finance, this is bubbles. Okay, so sometimes there's some security or some stock that becomes popular and its price becomes inflated. Okay, it's worth maybe a bit more. Its market value is probably higher than what it should be if you valued it from a fundamental perspective. Okay, but because of herding, even though the stock might be overvalued, people could be following others and still continue buying that overvalued stock. So this would be bad for their finance, but some people just do that. And one reason why that might be the case, so for example, if you are an investor in a company, it's really rare that the company is going to fire all its manager at once. Okay, so if everybody does some type of bad trade, then if you do that same bad trade, it's unlikely you're going to get penalized for this because they would need to penalize everybody, which they won't do. Conversely, if you depart from what others do, so if you're alone doing trade A, whereas all the rest of your team does trade B, and if ultimately trades A becomes less profitable than trade B, then you'll be alone having taken that bad decision. And you might get fired or penalized in that case. So herding in that case can be a way to avoid being penalized if you work in a group setting and where it's very rare that the whole group will be penalized for bad investment decisions. Okay, so there might be, in a sense, it might not be irrational if you're an investor and you look at your own personal needs on instead of your investors' needs. But this is first, it's not professional, and it has very bad. It can have very bad outcome for your investors. Okay, so you shouldn't do that. And that's it. So this was an example of a set of possible biases which are studied in behavioral finance. Of course, there are other types of bias. Feel free to consult Wikipedia or various other sources or books about behavioral finance if you're interested about this. It's a very interesting topic. So for those who are curious about this, I encourage you to have a look at this topic, and it can even have implications for your own personal investments if you have some savings and want to invest them. So here in this rest of slides, I give a few the references where I picked, let's say, the content of this chapter. Feel free to have a look at them too. All right, so this ends the chapter. I'll see you next time.